Chris. I'm Brian Jones. I'm here with Chris Hood. This is Hood Talk, the world's most interesting man, professional trader. We're about to talk about the market and give you guys some insights. How you doing, Chris?
What's happening, man? I'm good. How are you?
Excellent. I did killed it last week.
What's that?
I killed it last week.
Awesome.
I tripled my profit target for the week, and it was excellent. So,
well, I tell you what, first time probably in about a year or 2 years that we had nearly 15 winners at 100% or more. So, it reflects the system that we use, and it reflects the process that we use. So, market opportunity is there, the opportunity to trade it is there. We take whatever we can get. But 15 winners, I don't think there were any people last week that were getting the same results as us. So really, really good. I'm glad you got some out of it.
Oh yeah, definitely. What was the big one for you?
Citibank. We did a Citibank trade on Sunday night or on Monday morning, and by Wednesday we had already taken profit 3 times at 100%. One of the methods that I like, and this, is we put in our contracts. When we hit 100, we halve it, and then when it hits 100 again, we halve it again, and we continually then just work our way backwards. We can also leg it in, right? So as we go in with one, hits 50, we can add another one, adds 50, add another one, depending on the time frame that we've got on the trade. And this was a very short, a short duration trade. And I think on Monday, price opened up a little bit on Citibank. Tuesday came back down. It had a really nice pullback. There were some beginners that were like, oh, this is it. The world is ending. The typical beginner reaction. They wanted to exit the trade. At that point, we said, just hold out. This is just a normal pullback. The price was still above the moving averages. We added on the Tuesday, and I tripled my position at that point. I actually just put in 3 times more than what I put in on the Monday. And on the Wednesday, we got the pop. And on that point, it just flew from Wednesday to Thursday. I was out by Thursday morning. We had finished the trade already, but it had been subsequent 100, which was fantastic. Let me have a look here. Let me see which other ones we had. We had a 287% on the one leg. Then we got 100. We got another 100 on Caterpillar. We got a 200% on Target. We got a 100 on Pins. We got another 100 on JD. We got a 200 on Lulu. We got another 100 on Revolve. We got another 100 on Billy. It was just insane. We got 100 on Okta. Man, it was fantastic.
Definitely a good week.
Oh yeah, it was probably one of the better weeks for a lot of guys. But it's all about the plan, and this week's already got off to a good start. Guys are on return on cash. They're looking at around 40% already for the week. So that's pretty good,
For sure. There's been some crazy stuff going on in the United States. Obviously, you watch the news. And how do you see that affecting? Do you think this is going to? How much does the news really affect the market?
I think it does. I think the only thing that we saw on Wednesday, when all of these guys were storming the Capitol, was there was a minor pullback, and then the market sort of shrugged it off. Mm-hmm. I think a lot of people tend to trade on news, right? And we know how news reacts to people, right? So, people will look at it and go, oh, this is it, the world is ending. And then 3 days later, everyone's forgotten about it. And you would have made a decision based on that 3-minute window that you were watching, Jim Cramer split, shouting out whatever it is, or MSNBC or whatever it is. I think as you get more experienced in trading, you tend to disregard a lot of that, or you tend to use it less it shouldn't really be a filter for what you do. So I disregard it. I don't follow the news. I don't turn on the news and listen to these opinions. I really don't find it useful.
So you don't use it. It doesn't influence your trading at all.
No, it shouldn't. It's very hard to learn not to let it, right? Because what we tend to do as human beings is we'll make our decisions on short-term basis, right? So we'll go into a trade And then in 5 minutes, it starts moving against us. And as a beginner, what people do is they go, oh, I'm down 10%. What do I do now? Should I exit? Should I get out? This trade's wrong. And I often speak to my own subscribers when they call me and they're going, this trade's rubbish. It's pants. I'm down 15%. And I go, how much time do you still have on the trade? Oh, 738 days. Like, do you care? Like, really, do you care? It took a long time for me to learn that. It's very, very difficult when you're trading to keep the noise out. And this is why I'm so against chat rooms and all of that stuff, because it can create an internal conflict for you in terms of, doubting your own plan. If you've got a plan and you've worked it out, you've paper traded it, you've tested it, it works, you have your filters and your screens and in terms of the conditions that you will go in and out of a trade, your profit targets and all of that. And some circus clown comes up to you and says, hey, you should buy this. And if you don't have these filters that tell you whether or not it should go into your plan or not, it's not that you don't listen to it. I've never said don't listen to anyone else. You can listen to whoever you want as long as you've got a filter. So when you act, you're acting because of your plan, not because of Johnny at the gym telling you it's a great idea. So with the news, it's something similar. There's a whole bunch of people that follow
the shiny object syndrome. You got the shiny object syndrome.
Yeah.
So you're like, oh, there's that.
Yeah. It's like squirrel.
Yeah, squirrel.
It's like, in Canada.
It's trading ADHD.
Yeah. Oh, there's a lot of that.
I didn't mean to cut you off.
The way to get around it, though, is purely by writing down what you're going to do before you're going to do it. And I do that every day. So I go through my positions. I write down my plan. I know what my trades are going to be. I know what I need to do. I look at the graphs. I set little alerts on my graphs to tell me what to do at what point. And that regardless of the market condition. If the market drops 500 points, but my positions are still moving up, why would I worry? If my position changes, if the structure of the position changes, if the price moves below the conditions that I went in on, below a moving average, below a Fibonacci line, it's changed. The fundamental of the trade has changed. Then I will act. But, what these guys are talking about on TV, yeah, I think a lot of it does change sentiment. There's a big difference between sentiment and a trade. So if people become, bearish or negative, yeah, it's going to have a problem. But you'll trade that way. And there will be trade strategies that you can use when the market sentiment starts to shift. Where people become vulnerable is when they don't have enough tools that they can use and they don't have the skill to recognize when the market has changed. So if you're not looking at the things that are telling you what the weather is doing, it's like never taking an umbrella out when you go walking, but you can see there's gray clouds. You didn't even know that there was a storm coming, but you saw the clouds. You'd take an umbrella and a raincoat and you'd go out. So if you get wet and you had a chance to take an umbrella, well, the consequence is yours. You should have seen that. So it's the same thing in trading. You've got to know the climate that you're in and whether or not you need an umbrella or you don't need an umbrella. And those, you can look at them on a weekly basis. There are a couple of guys, very famous, well-known traders that look at year-long weather reports. How has this been over the last year? How has this been over the last 6 months type thing? That's fantastic to be able to do that. And often you need quite big, cojones to look at the bigger picture. But a lot of retail guys tend to see themselves as swing day traders, right? They come in, it's 5 minutes, 5 minutes, 5 minutes. They have got that trading ADHD. And I certainly encourage people to have, positions that expire on different time frames, and you've got different kinds of strategies. You're not always going long on the one side. You should be a little bit neutral here, a little long dated, but you trade the charts. You don't trade what your opinion is or whether if Cramer says this or that. No, that's not the way to trade. They're in the business of entertaining. The people on the TV, it's about entertainment. It's not about making you rich. No. So
how would you say in an up market, how would you play bearish trades in an up market?
It's hard to do bearish trades in an up market because a rising tide lifts all the boats, right? So what you don't want to be doing is going against the trade. All right. There are a lot of people, a lot of hedge funds that will take bearish positions on overvalued stocks. But remember, there's that famous statement that says the market can remain illiquid or irrational far longer than you can remain liquid. So if you're a guy that's coming into the market and you're going, Tesla should be $30 a share, and you're willing to take a risk that Tesla is going to go down to $30 because your opinion is that it should be $30, well, then you deserve to get your face ripped off because your opinion doesn't count. However, if Tesla's price suddenly hit the 8, and then it hits the 20, and then the 8 crosses over the 20, and then the 8 crosses over the 50, and the price is below the 50, suddenly your opinion might actually count.
Well, your opinion has to be backed up by data and charts and signals.
Absolutely. Absolutely. You know, opinion in valuation is irrelevant. No one cares. No one cares what you think. Doesn't matter. And, you know, no one cares what I think. I don't like Tesla as a holding for my long-term account. Doesn't mean I don't trade it. You know, I might think the company's rubbish, but, you know, I don't believe a company should survive only on government credits. Because if the government changes the rules, what do you do? What happens? So until they can make money making cars without government support, you know, it won't get my sort of tick for my own account. Doesn't mean I don't trade it. I trade it every week. I just don't want to hold the shares. So there's a way to trade it. And I think as a retail investor, you have to have tools that work at specific times, and you've got to know when to use it. You can't build a house only with a hammer. You know, there are going to be times you need a screwdriver, and there are going to be times you need, you know, window sealer and stuff like that. If you don't know when to use that, then, you know, the results are going to be completely inconsistent. You're going to take far more risk than you need. You know, I was reading some interesting books over the weekend around the science of position sizing. You know, it's a purely mathematical game. And you see some of these retail guys going, you know, balls to the wall, 5%, 6%, 8% positions in their account. You know, mathematically, what I was reading in this book.
Which book is it?
It's called Super Trader by Tharp. I mean, I like this guy. He's a really smart guy. I read this book many, many years ago. Let me pull the picture up. I'll get it on Amazon here for a second.
Is that something that you would recommend? What level of trader is that useful for?
I would say that anyone who's starting out in trading should probably read it. There are some pretty detailed concepts. I mean, you know me and planning, right? So I encourage my students to plan, write down, have your set of rules. He says the same thing. You know, the process is very, I don't think there's a unique process to one person over another. I think it's very generic, but he enforces the same things that I believe are true, which is you've got to take out your emotion. He says something about you don't trade stocks when you trade your belief. And I thought about it for a while, and I said, you know what, he's right. You do trade your belief, because if you believe Forex is the way to make your millions, well, then you're going to trade Forex. You believe it's going to work, then it's going to work. If you believe stocks always go down, then you're going to trade for that belief. If you believe stocks always go up, you're going to trade to that belief. So in this book, it's called Super Trader. I'm going to pull it up here on Amazon. And I love this book. I read it in 2 days. I'd read it before, back in 2008. It's been a long time since I read these books. But he is a fascinating guy. I really like him. I like the way that he writes. Let me share the screen. Give me a sec. Yeah, these are the books here. So this is the one that I finished this book this weekend.
Mm-hmm.
And he's got a couple of books. So I'm really, really, really good author. So if anyone wants to go and read a book that's going to help them in their trading, these are definitely the books to read. You know, it can be, I think for beginners, it might be a little bit too much to start with, but, you know, give it a try and see what happens. Really nice books. So yeah, it's, yeah, he's a good guy.
I have a question. So a lot of times, and I've gotten this, sorry, I had to cover my face and then talk into the microphone. But just one of those mornings, Chris. I need more coffee,
I've got mine here too, loading up, man.
So when I've mentioned options trading to people who were sort of into like management of equities and stock trading, it's always get that same thing about, oh, options are really risky. Do you hear that a lot? I mean,
Oh, yeah.
you've heard that a lot. So what's the origin of that? I mean, why do people think that they're so risky compared to trading stocks?
Because the thing is, when people look at options, they've only looked at it from one dimension. And often when you buy an out of the money call option, if you're like a Robin Hood trader and you're buying out of the money call options 2 weeks from now at 10 cents and hoping it wins, I can pretty much put money on that you're going to lose. There's the risk, right? The reason people think it's risky is options are designed to go to zero when you've bought them, right? So when you go in that this thing at the end of its life will have no value unless the underlying is at a particular price point. So yeah, it's risky from that perspective. The thing is, though, options give you so much more than stock because I can get a leveraged return. So my capital usage when I use an option rather than shares is going to be significantly less. So for example, if you go and buy Tesla shares, okay, it's $800 a share, right? Buying 100 of those to give you a delta of 100 will cost you $80,000. Right? Will it cost me that? Let me just check. Let me see. If I buy 100 shares of Tesla today at 827, my math is always terrible in the morning. It's going to cost me $82,000, right? That's for a 100 delta position. I could do the same thing going further out in time. So let's say I bought the 100 delta so that's going to cost me 82. If I go to March, and I buy a 100 delta, the cheapest 100 delta position I can find, which is the 550, will cost me 27,000.
Right.
So I get the same upside, right? My delta is the same, but I'm paying 60 grand less, right? So that's one way that I can spend less money. Number two, if I did a trade, let's say I did a calendar spread on Tesla where I bought the $80, 80 call option for Tesla in, let's say, January next year. So I buy the 80 delta. Well, how much is that going to cost me? This one's going to cost me $34,000. So I'm still saving 50, but now my delta is a little less. What I can do is take the 580 plus 34. So 580 plus 34 gives me 614. I can sell, as long as I sell a call option above that break even, I can actually get paid back now. So I might have put down 34, but I'm going to get back a big credit when I sell another call option at a slightly higher strike price. So I've got more flexibility.
So you think that people they think that they're risky because they don't understand it?
Yeah, for sure. Absolutely. There's a lot of misinformation. The problem, this is where the irony of it is, options were designed to hedge risk and take risk away. So
right.
when someone says to me, options are too risky, I'm like, when you buy a stock, you risk 100% of what you've put in, right? So that 80 grand, that's my risk. Unless I've got stop order, I've got a stop limit at this point, I can only risk so much or whatever. Advanced concepts aside, you're risking 100%. Which is more risky, risking 100% on 80,000 or risking 100% on 27?
Yeah, I mean, it makes sense to me now, but I just heard this a lot. I've heard a lot of people say it.
I think if you were trading, I got away from trading stocks exclusively 10, 15 years ago because the upside is not enough, right? How much does a stock have to move for you to make a viable return? If the stock price was 800,
you have to have a lot of capital to make a lot of money.
A lot of money. You've got to have a lot of patience. So it's incredibly difficult, I think, if you're a swing trader buying shares, to be able to make the sort of money you need to pay bills. I think it's hard. It's a lot of work. The way that we trade in terms of using options, I've got the leverage, number one. B, We have a proper position sizing methodology. So we're never over risking anything. And if that risk had to come to fruition and we had to lose on one trade, it's only 1%. So if I'm losing 1% of my account, let's say 3 times, on a 70% win rate, I'm losing 3 times every 10 trades. And when I win on the 7 trades, I'm winning more than what I'm losing on the 3 losses, right? I can only lose 1%. So if I'm winning more than that on those trades, I'm always going to have a positive profit factor, right? So I'm always going to be growing my account that way. So it's important to understand your win rates. Number one, you need to know how much you win on average and how much you lose on average. And the way to manage your account is to maximize your profits and minimize your losses. Some traders can't do both at the same time. Many retail traders can't do both at the same time. They tend to either have too many positions, not know where they're going to load up on good ones. So when you've got a good trade, are you willing to go from 1% allocation to 2% allocation? Because it's working, right? And when something loses and it breaks structure, do you have the signals and alerts to tell you that something's not working? Or do you rely on opinion? I feel this, the market's changing, let's exit. Do you let your P&L drive you, or do you let the trade structure drive you? Those are the things that will separate people that are consistently good from people who are consistently bad. And most retail traders don't learn that unless they go through the hard part of losing. And trust me, I lost a lot. At the beginning years when there was no one to teach me and you've got limited knowledge, what you're trying to do is you're trying to hit the ball. You're trying to hit a home run every time the pitcher comes up and throws a ball at you. So
this is an interesting question, because a lot of times, I know a lot of your client, you deal with a lot of clients that have a lot of capital, and you deal with clients that don't have that much capital. So you train all kinds of people. A lot of people coming into options trading may not have a lot of capital. So what about position sizing if someone only had $5,000?
I would be using butterflies. And I'd be using bull call spreads where the trade would give me a sort of 3-to-1 return. Right? Okay. So the thing is, it's not just about what you risk, it's what you're risking and what you're going to get back. All right. So you have to think about when you've got a smaller account, then you need to be doing trades where, a butterfly trade, a call butterfly trade at the implied move for next week on Twilio would probably cost you $130. To take a 3 or 4x return on that prior to expiry may give you a return of maybe $500, right, for that 100. So best case scenario, if I manage to just land that fly right at the end, on Friday at the middle strike, I might make 8 or 9 times my money. But the probability of me doing that is so slim, it's hard, because I've got to be managing it with my broker. I've got to be, I might have 20 positions on at the same time, and I just might not have the opportunity. So when I do a call butterfly, I will close before the expiry at 3 or 4 times my money. I'm happy with that. I think no one goes bankrupt. No one goes bankrupt at 300%, right?
Right.
So it's about picking the strategy that works most appropriately for your account size as well as the trade itself. So I could go to a guy and I could say, here's a long call opportunity that I'm doing. Bang. And that long call is $2,300, right? For a guy with a small account, that's almost impossible. But what's stopping him from learning how to do a call butterfly and doing a call butterfly for $130? We both want the same thing. We both want the stock to rise. One of us wants the stock to rise indefinitely and to a price wherever, and I get paid for that. And the other one wants it to land on a specific point. And those specific points are mathematically derived. They're not difficult to calculate if you know what you're doing. So you take the math that's in the market and you apply it to the trade. I think there was a period a couple of weeks ago where we were doing 5 of these butterflies on Tesla every week. And we were just creating these butterflies that overlapped because we didn't know if Tesla was going to move $100 up or $200 up or 250 up. No one knew. And we were doing these overlapping butterflies, and each one, I think in that 1 week, we had all 5 land up winning at some point, because our intention was never to hold to the expiry. We were just, as the stock was rising up and that butterfly became more expensive, it would close. And then this one, then that would close, and then that one would close, and so on. So there's definitely picking the strategy that works for your account size together with the stock. That's first. Number 2, if you've got a trade, let's say it's a debit trade, all right, and you're going to be doing a long call option, you've decided that you're going to do the long call option. There is nothing stopping a trader from doing a credit transaction on the other side to do it for funding, right? So we do a bull call spread on the one side and we sell a bull put spread on the other side. And what happens is the credit we receive pays off the debit that we paid. And that's slightly more advanced because you've got to get your timings right. You don't necessarily have to sell the credit for the same expiry as the long. Right? I tend to do my credits on a shorter time frame and my debits on a longer time frame, because what I want to do on the long time frame is let time work in my favor so I can be right. And on the shorter time frame, I want time to work in my favor when it erodes the option and I get paid quicker, right? So if I'm doing a 90-day call spread, I'm going to be doing a 30-day credit spread. So I'm going to use the money in the next 30 days, probably close it in 14 or 15, to pay off the cost of that spread on the long side, so that, and this is the clincher, by the time of expiry, I want the cost of that debit to be 0. I want the market to have paid me back for the entire trade, so that if the stock is trading at my expected move, it's all profit.
Oh yeah, nice.
That's the way I trade.
That makes perfect sense.
But it takes time and patience, right? So you could take, I tend to do those types of trades with ETFs, because I don't want to have to hold them through earnings and all of that. I might size them a little bigger. I might do it based on things like China. You know, China is an interesting animal because there's so much money that sits in there, and the stock market is like this sort of hobby for everyone there. I don't think I've ever met someone who lives in China who doesn't trade. So, you know, and it's counter to the US, right? So I don't always want to be exposed to the market in the US entirely. I also want some other countries, right? So let's say I take China. And I will buy it based on the long-term index, do a 9-month bull call spread. And then as this trade starts to develop, I'm going to be selling either a naked put or a bull put spread just to keep reducing the cost of that transaction. So I might have gone in, let's say I had a $25,000 account. I might have gone in with a $3,000 position, just under 10%. But within 2 months, I might have already made back half of that $3,000 already in bull put spread credits. So now I've only got $1,500 at risk, and I've still got all this time. Do it again, now it's down, and effectively you take your risk and you keep reducing it until eventually that long position is at 0. Do I care what the market does now? I've already made my money back. No. So, you know, one thing I like teaching people is initially when you start trading, return of your capital is more important than return on your capital. Get your money back, then we can talk. So if you structure a trade that allows you to sell half right up front, so at 50% profit you sell half, you've reduced your risk. Or if you sell it at 100% and you halve your position, you've cut your risk down. That's the most important thing, I believe, for me, particularly in the first half of the year. Right? So as the year is progressing, the first half of the year, I get my return of capital. I want all my money back. In the second half of the year, once I've already achieved my numbers, maybe I can leave some money on for the year. You know, I might risk a little more depending on the opportunity. But it's very important to get your money off the table when you can, earlier rather than later. So there are a couple of people who will, you know, keep loading, but they've got no profit target in mind. So they don't know when to get out.
Right.
They just keep throwing it in. It will never come down. Bang, one bad day. All of that money.
I like to take a little bit off the table. I like the legging in approach. That's what I've been using.
Yeah.
into the
It
trades.
works really well, especially especially if you start off with a sort of, I call them scout positions, because you're going out and you just want to see if you're right.
Like reconnaissance.
Reconnaissance.
Yeah.
Like my great grandfather
Yeah,
back
exactly.
in the day. There you go. So you scout these positions, right? You put it in, it's $200. Doesn't matter. Like if I lost 100% on that, okay, don't care. And let's say that $200, suddenly that position starts to move. Check the charts. Is it within the realm of where you said you were going to add more? Right? Remember, and options aren't just priced based on the price of the underlying. There's volatility, there's time, there's intrinsic value. There's all of these things that have to be factored into the price of the option. So you can see the underlying stock moving, but the price of the option hasn't changed yet. Right? You can see situations like that sometimes. So if the price hasn't moved above a particular Fibonacci line or moving average and it's still there, but the trade is starting to work in your favor, add a little more. Put another 200 in. It halves your return and your allocation might still be under your 1%, but you can keep adding. Now, by the time this thing, if you're using the TTM squeeze indicators, when the Bollingers go into the Keltners, now all of a sudden we start entering at the bottom, right? So when this indicator starts to turn, we go in. We then start adding on the third column. We start adding on the fourth. All of a sudden you see a little compression dot. Then it starts moving up. By the time it starts firing long on your key chart, which could be the daily, the weekly, the hourly, whichever way you're trading, that's when you want to be fully allocated. You don't want to be fully allocating yourself once the stock has already started to make its move. You want to be doing it before. So the problem that a lot of traders have is they get in either one day too late or they don't get in at all. They miss these opportunities. So how do you counter that? Is to say, you know what, I'd rather be one day early with less than 2 days late with nothing. So it's a mental thing, right? It's like, okay, you know me, I do 40 to 50 trades a week. When I'm doing those trades, I can't afford to miss out, right? So I have to do a lot of trades. My account's slightly bigger than most, but I do a lot of trades because not all of them are going to win. I know they're not going to win, but I have to be playing the game in order to win.
Right, so you trade volume. What's the
problem? I have to have a volume because for me, I don't like risking a lot of money. I'm not going to go and risk $10,000 on a trade. No, I'm risking maybe 500 or 1,000, but you have to put these little controls in place. So put your scout out there. Your scout will send you a signal saying, you know what, this trade's actually working. Add some more, add some more, add some more, add some more. Oh, it's starting to fire long. Start exiting. Once the price pops, take off a third, take off 2/3, take off half. It's up to you, but try and get your capital back. And if you can sit back with a strongly trending stock with 1/3 of your position risk-free sitting there, you don't even have to worry anymore. That's the safe way to trade.
So, yeah, I like that idea. I mean, obviously, I'm following your system, and it's working really well for me. What I was just curious. Just kind of want to wrap up with something that's going to. What is on your watch list for, let's say, like the one that you're really looking at to do something over the next probably 2 to 3 week period that you're kind of.
Two trades that I'm actually quite keen to do at the moment. The one that's been really interesting over the last couple of days has been the Bitcoin trades. Yesterday there was a 20% sell-off in GBTC. I can't get the graph up here. Finviz doesn't put the graph up, but big sell-off in Bitcoin because JP Morgan may be coming out with an ETF this year. And GBTC is a proxy for institutions to go into Bitcoin. So there's a bit of a premium that sits within the price of GBTC relative to the price of Bitcoin. And that premium looks like it might erode. Now, fortunately, I don't overload in anything. So as much as I'm in it, I reduced my position by 1/7 yesterday and I'm fine. I think that still the Bitcoin stuff is interesting to watch. Still an opportunity sits in there. The
You
bear
don't like to
case for
buy the
Bitcoin.
actual Bitcoin. You just prefer to trade the ETF.
I'm not smart enough to work out these crypto wallets things. I mean, no, it's too complex for me. Can't teach this old dog more tricks. The only trick that I've got at the moment is getting up and staying mobile. So, asking me to do a crypto wallet would be crazy. Bitcoin is one. I'm really, really liking pins at the moment. This stock is just, I mean, you can see bottom left, top right, inner channel, bounces off the channel. Look at the behavior that we see once it hits this channel and this price move up. So pins is one. You can see the compression starting to form, with this graph, the lines coming in. Pins is one. I'm really keen on AMD as well. The semiconductor sector is just on fire, at the moment. So this is another one. You can see it really close to the edge of that channel, that upward resistance line, upward support line there, resistance line. If it can get above this line, this stock is going to fly. I think we've got 5 or 6 positions already over here.
So is that SOXL is the semiconductor?
I like SOXL. It's just a little too volatile and expensive for me. So I'd rather go for one of the constituents of the whole index itself.
Right.
We did a good trade last week on Texas Instruments. So I'm just sticking with what's working. I think that the setup here was better. I like it when the stocks chop around towards the bottom of these channels. When they do this and they compress at the same time, this sort of price movement is inevitable. So getting in, I think we got in on Friday. That was around here on that red. And we got this pop yesterday and now a little bit more. AMD, I'm long term. I like Charles Schwab. They bought TD Ameritrade, I think, in America. Had some good numbers that came out in terms of their growth and new account opening. So I really like this one. Look, you can see it there in the upper reversal zone or just outside the Bollinger. Nice sort of support line being created there. We can see these higher lows and higher highs. That's really nice and bullish on the stock. The other one that I really like, this is like a little bit of this is a punt if there ever was one, is these guys went and bought thousands of these computers to mine Bitcoin. I think 7,000 or something, if I stand corrected. But these guys went off and bought all these machines. And you can go back here just at the beginning of the year. We bought a long call option on the day that they announced they'd bought these machines. We bought a long call option in Marathon. And our long call option now is up 97% since we did it. We did the trade for January 2023. We decided that we were going to go so far out that most of us would fall asleep holding the stock or holding the share. And we bought it so deep in the money. We bought it at $7. So it was trading around $10 a share. We bought it when it was around $7. So we got the strike is somewhere here. And now with the, our break even is 17. So we paid 10. So we're up here with our break even. This stock is just going to fly. If Bitcoin moves up in price, this thing is going to make a ton of money. We also did a bull put spread on the side to finance this trade. So we got back a credit that was equal to the cost of the long call. So we're actually sitting in this trade risk-free, and it's up 121% since we went in. So this trade is a really nice one to look at.
There's more upside there.
Oh, yeah. Especially because I've got 738 days to think, to be right. So the 738 days, I might not hold it for that long, but it takes away, when you buy long dated leaps, it takes away some of the short-term angst that you would have in the trade. It gives you a little bit more leeway for it to work. There'll be some option guys out there that say, oh, it's a waste of money. You bought too much time value, blah, blah, blah. I don't see it that way. I find having these long positions, particularly for my base portfolio, so the stocks that I don't trade, they're very useful because I will take the profits out of this trade and physically buy shares in this company. So I'm not paying for that stock with capital. I'm paying for it with profits that I've made from trading that stock.
So you like to buy the long term the leaps contracts on stocks that you want to hold.
Yeah.
Okay.
Yeah. So this is another one. We did a trade on this one. I really like this company too. It's a small stock brokerage in China. And you can see we did this trade. Where did we do this one? We entered this trade, sorry. We entered this trade. We bought the July 5 call and we entered this trade on the 31st of December, like literally right over here on that pullback. We bought in, we got this closing here. It was probably this candle over here. Our long call option is up 26%. I've been adding to this position every couple of days. I'll be adding more into it. And we sold a naked put as well against this to finance the trade. So we got the naked put premium that paid off the long call. And I'm just going to continue to hold it. Trades in the perfect sweet spot from a zone perspective between this midpoint and the upper line. I think this stock's going to fly. So those are some of the picks that we've got at the moment that are looking really good. If I just look across my book at the moment, I'll tell you what else we've got. I still like Baidu. This is a stock worth buying for the long haul as well. Don't overload this though. You know, what's going on with Alibaba and all of that stuff and the politics of China and rich people and all of that. I don't get it very much, but I like the zone that it's trading in. You can see how it hugs this line and it just stays in this upper zone. So on Baidu, long call debit spreads are probably the safest bet. Our lithium trade is still working fantastically. So, you know, if there's one thing that I can be sure of is that the price of lithium will go up. You know, regardless of the electric car sales or whatever you want to look at, lithium will go up. There's only so much. And all of these guys have got lithium batteries, right? So they need this stuff. I love this trade. We've been in it for quite some time. We've already done a double. And we've still got a position that's up over 50%. Another one to end with, you know, when you think about what's happened over the last 2 years, probably, there's been a massive amount of money going into growth stocks. And what that's done is it's created quite a dichotomy with value stocks, right? So there is going to be a rotation into value, I think. You could see this happening towards the end of October. The sort of flow of money was coming out of growth ETFs into value ETFs. We took a position in IWN, which is the Russell 2000 value ETF. We bought a January 2022 call option at 125. That option is now up 105%. So that's a double. We got that one in on the 18th of November. We did that. So we also we did this as a bull call spread, doing the 125, 160 for January next year. So I think this one is a long-term, you know what, you could just buy and hold this kind of thing. I think that there'll definitely be money to be made on the value side this year. Another one, sorry, I get all excited when I have this.
I know.
There's some ideas that come out.
Yeah.
Well, one of them, another trade that I really like at the moment is Russia. Don't tell Trump. But we did this trade on the RSX, which is the ETF for Russia. We did this one on the 4th of December. So round about here. It was on this pullback to the 8th, somewhere there. That's when I went in. We went in on the next day, round about there. We bought the May 23 call option. So pretty much at the money, but for May. And we've gone through that little dip and now it's back up there. This position on the May 20, on this is up 80% since we went in. Just looking across all of these things, I like the look of Berkshire Hathaway at the moment. I think that there'll be something popping out of Berkshire Hathaway. So we've got a trade in here as well, on the B shares, obviously. These A shares are very expensive. I love the way that this trades. If you just watch, look at the symmetry of this. You know, hits the
Yeah, it's definitely
bottom,
it's like the pattern is
and you can see this the wedge starting to narrow in. That's a really good sign. When this starts to narrow in, and this will pop above the top end of the wedge, you're looking at quite a breakout there. And you can see this explosion. Look at that. You see the compression starting to happen? Explosion. Compress, explosion. It looks a little bit like an intestine. Sorry to say that, but it does look a little bit like that. So I think Berkshire Hathaway. So if I had to pick 3 long-term trades, I would do IWM or IWN, Berkshire Hathaway, and Charles Schwab. Those would be my 3 long-term. My short duration speculative ones would be MARA, TIGR, and RSX. If I was looking to do short calls for this week, pins would probably be the pins, and AMD would be the ones I would be doing for this week. Their charts and the technicals look really good. So those would be the 2 that I'd look at for this week. In our trade file that we had on Saturday, TTWO, Plug, and VALE were the 3 that came out. Little nervous about Plug. I think it's a bit overextended at the moment, so it's vulnerable to a pullback. If you did trade it, it would have to be on a cheap basis, not an over-allocated basis.
Mm-hmm.
VALE, I like VALE. This one also looked really good. This pullback really nice. That's what you want to see. A lot of people get scared off from there, but this is what you want to see. You want to see these pullbacks. And look at the volume. I mean, this buying is fantastic. So those would be the 3. And you just heard the bell.
Yeah. All right. Well, Chris, great talking to you, man. And happy trading today. I hope you kill it and make a lot of money.
Thanks, buddy. We'll speak soon.
Yeah, absolutely. Until next week.
Take care, man. Stay safe.
Yes.